So, I welcome you all to the second day for Game Changer webinar session for taxation being held under UK stream. In last day's session, we did discuss few important tips which are useful while dealing with section C questions of taxation. And well, we did two questions. Question number one of worth 10 marks, which could be tested from any area. And sometimes it does contain an element of planning in it as well. I mean, examiner might give you a situation which is, although a short one, but he may give you a situation that what is going to be a tax difference, additional tax, or tax saving that could be achieved by adopting a certain policy. As you could, I hope you remember that in last day's session, a very minute issue was discussed that if the freehold warehouse is going to be sold on 1st of April, then what is going to be the tax implication? And what if we plan to sell it off 10 days later on 10th of April 2024? Then what is like going to be a change in the amount of taxes, or well, if there happens to be any other change as well. And if you people had been a part of last day's session, you might remember that there was like no change in the amount of taxes. I mean, the CGT figure would remain the same, but it's just that the payment date must have been delayed by 1 year. Okay, so this is how in first question you will always be given with a short and understandable, but a planning oriented part will definitely be provided to you people. And here, this was the third question which we had started off with. Though we did discuss the trading profit calculation, but I really want you people to go through the question once again. I will quickly tell you that what we did in the last day session, and then we'll continue from the point where we left earlier. Okay, so kindly start reading the question. All right, so you must have gone through the question. And see, this question did have only one huge requirement of worth 15 marks, in which we had to see that on the basis that all the available claims and elections are made, we need to calculate Sliving Limited's taxable total profit for the year ended 31st March 2025. Well, by taxable total profit, we mean to say that uh, at the point when the corporation tax liability for a company is to be calculated, it does include income from all the taxable sources. And that's how we come to know what the total profit for a company is. And then we deduct the qualifying interest, qualifying donation payment. And once the qualifying donations, which we call as qualifying charitable donations, are deducted, then we come across a figure which is called as taxable total profit, which is basically asked over here to be calculated. And it is the taxable total profit on which corporation tax rates shall have to be applied. Now, it is mandatory that you need to go through the notes, because sometimes examiner asks you to present your answer in a specific manner, and if you do not present your answer accordingly, then marks can be deducted. So it says that your computation should commence with the draft trading profit figure of 982200 pounds, indicating by the use of zero any items that do not require adjustment or are not to be included. All right, so what we did last day, we had calculated the tax adjusted trading profit figure. As you have gone through the question once again, you must know that in this case, the trading profit figure is like still requiring a few adjustments to be made. And they say that the legal fee is yet to be deducted. The qualifying there are certain donations which are to be treated as well. And then there is a case of the purchase of the building along with the integral features of building, on which tax implications need to be taken into account. So when it comes to the legal fees, as far as any capital activity, any one-off activity is concerned, any legal or professional fee associated with it will not be considered as allowed, which is why the legal fee associated with the purchase of freehold building and the issue of ordinary shares is not going to be deducted. But the legal fee related to the registration of trademarks, as the registration of trademarks, the copyrights, and patents, these all are considered to be an allowed expenditure from HMRC's perspective, which is why any legal or professional fees associated with it shall be taken as an allowable expense as well. And well, if these expenses have already been deducted against the trading profit figure of 982200, then I would have made no further treatment. But here they say that legal fee is yet to be treated, which means that if an expense is allowed, then I will definitely deduct the expense. And then taking the loan and repaying the loan is a routine matter for a business. But whenever you're going to get a loan or repay a loan, the loan figure is not going to get treated against trading profit figure, but interest that is associated with it, that is deductible. And well, if you are going to incur any legal fee, again, it is something which keeps on happening in a routine manner as far as companies matters are concerned, which is why this is also deductible. So 2880 and 5470, these two expenses are to be deducted. Then there was a qualifying charitable donation of £4,600. I am not going to deduct it against the trading profit figure because this is deductible against the overall profit figure for the company. And as far as the political donations of £600 are concerned, see, donation to political parties are always considered to be disallowed expense. Then a second-hand freehold office building was purchased, which was primarily constructed 15 years ago. If this is an old building, then SPA on the cost of the building is not going to be taken into account. But alongside the building, some integral features related to the building were acquired as well, which includes ventilation system and the heating system. And well, they are the systems. They basically are the typical examples of plant and machinery on which capital allowances shall have to be calculated. And well, capital allowances are to be calculated in a way as how we calculate our allowances on special rate pool items. So £14,700 and 23,900 together, the cost will qualify for annual investment allowance. And if any value is left behind, this is the company which has got a choice. If the assets belonging to the pool are new assets, then after applying AIA, they may go for applying first year allowance at the rate of 50% rather than applying WDA at the rate of 6%. But we did not have to go till that point because the cost of the ventilation system and the heating system is easily gonna be covered against the annual investment allowance figure. Then there are no brought forward WDV values given. Otherwise, we must have calculated capital allowances on it as well. And remember this point always, that in case of companies, the tax adjusted trading profit shall always have to be calculated by applying accruals basis. There is no cash basis as far as companies' adjustment of profit is concerned. Then in the fourth point, they did go for a new building. Well, if it is a newly constructed building, as all the buildings which are constructed on or after 29th of October 2018, they will qualify for SPA, the structures and building allowance, but only the structural cost will be considered. Well, 384,000 is the overall price, which includes £94,000 being the price of land, which I need to exclude, and then SPA at the rate of 3% shall have to be charged. But it is unlike how we calculate capital allowances, where the capital allowances percentage tends to get changed according to the length of an accounting period. Here, in case of SPA, we will consider the usage pattern. We need to see that for how many months the building has been used for trading purposes, as the building was first brought into trading use on 1st of November 24, and the accounts are compiled on 31st of March 25, which indicates that for just a period of 5 months, the building has been used, which is why SPA for a period of 5 months shall have to be calculated. And the last point was related to loan notes and their interest implication. As I had already told you, when the loan is either going to be taken up or it is like going to be repaid, the treatment shall not have to be taken into account. But when we pay interest on it, we need to see how much interest payment is associated with it. It is of £3,300, but it does include a brought forward accrued figure of expense. Well, brought forward accrued expense would mean that this expense is not associated with the current accounting period. Rather, it is like matching with the previous accounting period, and on accrual basis, any expense which is not related to the current period shall not be entertained, which is why from 3,300 we have deducted 1,100 pounds, and the remaining interest expense is going to be deducted. So this is basically those items which we did discuss in the last day's session, and that's how we've been able to adjust our profit completely. And the adjusted profit figure is of 929,425. So I'm just going to continue from this point. The company has made accounts from 1st of April 24 to 31st of March 2025. Do not forget that company will always be making accounts according to an accounting period, and well, accounting period is the period in which number of months are either 12 or less than 12. And we have adjusted our profits. The profits figure is of 929,400. Sorry, 425. And then there is like still some other information available. It is about chargeable gains, which says that on 20th of February 2025, Sliving Limited sold its entire shareholding, a 1% shareholding of £1 ordinary shares in JKL Public Limited Company, an unconnected company, for 136,800. Sliving Limited had originally purchased 24,000 shares in JKL Public Limited Company on 1st August 2014 for £39,600, and the indexation factor from the date of expense till December 2017 is of 0.082. Well, 24,000 shares were originally purchased, and all of these shares are going to be sold. I do not have to apply the matching rule where we pick up the cost according to the same day. And then in case of companies, we need to pick up the costs related to the acquisitions happened in the past 9 days. And then we'll be like moving to the pool, which is FA 1985 pool. Why is this so? Because uh, Sliving Limited did not acquire the shares in JKL Public Limited Company in a step-by-step manner. Rather, they acquired the shares once in 2014, and now they are going to dispose them off completely. So here I am going to do the calculation first, and what I have actually told you people before, that whenever you require to do a certain working, first of all, you will be showing the value in the main format, and then you need to go down vertically and do the relevant working. And do not forget to put the reference number, as the reference number over here is working one. Okay, so here I am going to see what the disposal figure is. Sliving Limited has sold the shares for 136,800, against which we need to deduct the cost. The cost of these shares is of £39,600. The calculation of gain or losses in case of companies is very much same in comparison to how we do the calculation for individuals, but there are few differences, out of which the biggest major difference is that companies may deal with indexation allowance, I mean inflation, but maximum the element of inflation shall have to be taken up till 31st December 17. Why? Because after that date, the concept of inflation has also been frozen for companies as well. So what is like going to be unindexed gain in this regard? The unindexed gain figure in this case will be of 136,800 less 39,600, that's of £97,200. And then we need to deduct the indexation allowance, which is always calculated by multiplying indexation factor over cost. And well, indexation factor will always be given to you people in your exam. It's 0.082 into 39,600 being the cost. Well, now I will be able to determine an amount of inflation, and keep one thing in mind, that inflation, indexation allowance, shall never be crossing the value of unindexed gain. So 0.082. This is going to be of 3247. So with the help of indexation allowance, we are going to reduce our unindexed gain. Now our index gain, or you may also call it as chargeable gain, the one which shall be taken to corporation tax pro forma, is of 93953. So this is like said to be the chargeable gain. And see, it is appearing in the cell C28. So I'm just going up to approach the performer. In front of chargeable gain, I'll first insert the sign of is equal to, and I'll mention C28. Pressing the button of enter, see whatever the value we have calculated in the cell, that is going to be replicated over here. And this is how the calculations are to be done. Is there anything else which we need to consider? Because there is something which we still have to take into account. Though the share calculation has been done perfectly, but there is like something else as well which we need to cater first, and then the chargeable gains are to be technically taken to this corporation tax pro forma. Does anyone remember what could be that? See, this is not the only thing that Sliving Limited will have to take into account. They do have subsidiary companies as well. Sliving Limited has got 80% shareholding in Up Limited, and similarly 80% holding is found in Down Limited. So both of these companies are having a direct shareholding of 75% or more, and there are no indirectly controlled companies in the scenario. So if all the companies which are there in the group are okay, Up Limited is in turn having 80% shareholding in Down Limited. So technically, Sliving is controlling Up Limited with 80% shares, and Up will be further controlling Down Limited with 80% shares. So basically, this is a chain structure. These both companies are not being directly controlled by Sliving Limited. Rather, Sliving is directly controlling Up Limited, and Up is directly controlling Down Limited. Or in other words, you can say that Down Limited is under an indirect control of Sliving Limited. Well, if you want to make a chargeable gains group, first of all, the companies are said to be UK resident companies. And well, these three companies are said to be UK resident companies, number one. And then at every point, the the direct shareholding has to be at least 75% or more, which is the criteria being fulfilled over here. And in all such companies where the parent company has got an effective shareholding and indirect shareholding, the indirect shareholding has to be of at least more than 50%. So it's like Sliving is directly controlling Up, but indirectly controlling Down Limited. So I shall be multiplying first percentage with the second percentage. It's like 80 into 80%. What would that be? 80 into 80%. First percentage is to be multiplied with the second percentage in order to determine the effective shareholding. And this turns out to be 64%, which is more than 50%. And that would mean that these three companies, Sliving, Up Limited, and Down Limited, they all are found in the chargeable gains group. And well, if these companies are going to sell any asset with each other, then there is like said to be no gain or loss computation. The assets are considered to be transferred at on no gain, no loss basis. But if they are going to make a disposal outside the group, then definitely gain or loss shall have to be calculated. Could you see that Sliving Limited has sold shares? If they had sold the shares either to Up Limited or Down Limited, then gain wouldn't have been calculated. But Sliving Limited had sold the shares to an unconnected, unrelated party. It is explicitly said, which is why we have calculated the chargeable gains figure for Sliving Limited. But on the other hand, there is one more treatment which may apply over here, that all the companies who are a part of chargeable gains group, they may match their gains or losses against the gains or losses of other companies who are found to be there in the chargeable gains group. So could you see that Up Limited is like having a capital loss of £23,300, And Down Limited is having a capital loss of £9,900. And these are those losses which have been generated in the current accounting period. And these two companies, Up Limited and Down Limited, do not have any chargeable gains against which they could make an adjustment. And it is said in the question that where possible, all decisions, that would mean, will have to be taken into account to reduce the taxable total profit of Sliving Limited. So, considering these three companies being Sliving Limited, Up Limited, and Down Limited, they all are in the chargeable gains group. We may apply the concept of notional transfer where the assets actually sold by Up and the Down Limited are considered to be as if they are sold by uh, Sliving Limited, so that they may adjust the losses against their own results. And what would happen then? Of course, if they are going to treat their group losses against their own gains, their overall gain figure shall be reduced, and hence their tax liability will be reduced as well. So, as both companies are eligible to surrender their losses. So, Up Limited capital loss is now being shown as a loss for Sliving Limited. This is of 23,300. And similarly, the loss of Down Limited shall have to be treated against the gain figure of Sliving Limited. This is the concept of notional transfer where the gains or losses generated by one company are no longer be treated by these companies. I mean, Up Limited will not be treating their own capital loss. Neither Down Limited will be treating their own capital loss of 9,900. Rather, they are to be matched against the chargeable gains of their chargeable gains group member, which is Sliving Limited. All right. So by, sorry, adjusting the capital losses against the capital gain of Sliving Limited, the overall chargeable gain figure will definitely be reduced. And then whatever the gain value is left behind, that is something which Sliving Limited shall have to take into account. So what that value is, this is of 60,753 pounds. Are you all getting this point, that this is basically the gain which Sliving Limited shall have to take into account? And it's appearing in the cell C32. Is this thing clear to each and every one of you? Is this thing clear? All right. Okay. Thank you for letting me know. Um, Now the next thing is that I am just going to pick up the gain figure and I'm going to take it to the main performer. And from presentation point of view, it is better if we are going to insert the cell reference number, because that's how the information will be directly copied. As the value is appearing in the cell C32, I'm going up to the main format. And what will I do is equal to C32, pressing the button of enter, and the same information will be shown over here. Now we are calculating Sliving Limited corporation tax performer. We will not be calculating corporation tax liability, but we will be calculating their taxable total profit, which includes profit. Well, it is there. The chargeable gains, that's also there. But we need to see if Sliving Limited had any rental income or any dividend income or any interest income. Why the dividend is not to be taken into account? Won't I have to consider the dividend? Let me just tell you the first part. Yes, Sliving Limited will not be including dividend in their corporation tax performer, but what's the reason behind that thing? Does anyone know why we will not be taking into account the dividend figure in corporation tax pro forma? Okay, in case of companies, the dividend income is treated as an exempt income, which is why dividend received shall not be taken into account. Well, there is no other income in the question. Now I need to see that what the total profit for the company is. That is going to be of the total profit for the company for the year ended 31st March 25 is of 990,177.8, or you may simply round it off as 990,178. All right. See, this is the option which when you'll click, let me just try to enhance the image. It actually says 0.00. So if you're going to click on it, you will be given with an option to either round it off or to take to two decimal points. And well, if you're going to take the values in decimals, then from professional perspective, it is the two decimal points which are considered to be relevant, right? Okay, so well, we have come across the total profit. Against total profit, we deduct the qualifying charitable donation. I hope you remember that in this question, there was an information related to qualifying charitable donation given as well. And well, it is right there. The qualifying charitable donation figure is of £4,600. Do you know that when the company is paying the qualifying charitable donation, it is to be deducted against the overall profit figure, which we call as total profit for the company, right? So £4,600 is going to be deducted against total profit. Now, what is left? See, the question is there in front of you. Let me just take you to the point which may still be taken into account, but now the ball is in your court. You have to tell me that what should I consider further? Yes, it is the trading loss, because if the companies are found to be in group relief group, the group in which losses could be surrendered from one member to another, provided the companies are UK resident companies, then losses could be surrendered from one company to another, and the claimant company shall have to utilize the loss against their total profit less qualifying charitable donation, or in simple words, they may adjust it against taxable total profit. Well, it is the current trading losses which may be adjusted. And if the surrendering company has got brought forward losses, then they will have to make an adjustment of their own brought forward losses against their own results first. And then the excess amount of losses can be surrendered to the group member. Well, first of all, I need to make sure that whether these companies are found to be in the group relief group or not. As for being a part of this group relief group, the direct shareholding has to be at least 75%. Well, at both levels, the shareholding is 80%. So the criteria of at least 75% is being fulfilled. And then the parent company should have got uh, an effective shareholding of at least 75% or more in all of its indirectly controlled companies as well. So direct shareholding criteria is being met, but when Sliving Limited relation with Down Limited is concerned, and I'm going to multiply the first percentage with the second one, That indicates the percentage to be reduced down to 64% because 80 into 80% will be 64%. And 64% is something which is not admissible when it comes to group relief group. So Sliving and Up Limited, these two companies are making a group relief group in which trading losses, excess rental losses, and excess qualifying charitable donations could be surrendered. But when we come across against Down Limited, this is not there in the group of Sliving and Up Limited. Though Up Limited and Down Limited can make a separate group, but this is something which is not a part of our syllabus. Okay, so right now I'm preparing the corporation tax performer for Sliving Limited, and they observe that there is a current accounting period trading losses of Up Limited and Down Limited both. The Up Limited trading loss, and see, even the accounting period is same, so the period is same. Their trading loss can be adjusted, and well, the loss figure of Down Limited is not gonna be adjusted because the shareholding criteria is not being fulfilled. And well, Up Limited's loss when it surrendered against the taxable total profit figure of Sliving Limited, that's of 35,700. Okay, so after adjusting the losses, I need to see what the taxable total profits for this company would be. That is going to be of 949,877.8. So this is like said to be the correct answer. Is this thing clear? So this is how we've come across what the tax adjusted trading profit and then the chargeable gains of Sliving Limited is. And after deducting the QCD and taking an advantage of trading losses adjustment, this is how we've come across the taxable total profits for the company. Is this thing clear? We did not adjust the losses for Down Limited because as for a group relief group, the direct shareholding has to be 75% or more. You can see the direct shareholding is 80%. So the least permissible criteria is being fulfilled. And then the indirect effective shareholding has to be at least 75% or more as well. Sliving Limited is controlling Up Limited directly. But when it comes to Sliving and Down Limited, Sliving is controlling Down Limited indirectly, which is why I need to figure out the effective percentage. So 80 into 80%, that gives rise to a percentage of 64% only, which shows that an effective shareholding criteria of 75% is not being fulfilled, which is why the loss of Down Limited cannot be surrendered against the taxable total profit of Sliving Limited. I mean, Sliving and Down Limited cannot be there in the group relief group on the basis of not fulfilling the percentage criteria. Is that thing clear? Now, students, when it comes to this exam attempt, which got tested in December 2025. This is the exam attempt which we could do because it was according to Finance Act 2024. Well, in this file, you may only find section C questions, which have now been done with you people. And there is a pre-March 2026 mock which has though been released by ACCA, but this is the same mock which we will give you on 21st of February. You will have to solve the mock under the exam simulation, and then I'll check it and we'll let you know that what had been your performance. Well, as far as the rest of the questions are concerned, there is a pre-December mock as well, which is doable by you people, and it does contain the OT and OT cases as well. But apart from them, there is like no other exam attempt available on the portal which can be solved by you because that is like not relevant to you people. Either the rest of the attempts are old, they are according to the old Finance Act, and there are even two practice exam sets available on the portal as well, which have been adapted according to those students who will be taking their exam in June 2026 attempt. I mean, which is like already adjusted against FA 2025. So this is like September December 2025 attempt, and then the pre-December mock 2025 and pre-March 2026 mock. These are the only things which you can do on the portal. And well, I'm just suggesting you not to touch this pre-March 2026 mock, because this is the same mock that you will have to do on the mock day. Now, we still have to go through section A and section B questions, because I really want to do questions with you people, and would like to keep on suggesting you that what tactics you need to apply while going through such questions, which is why I have selected few questions which ACCA had once released, but they are no longer there on the portal. So this is like going to be a good addition to your practice set. Let me just open them up for you. There you go. So this is section A. Section A, as you all know, will be containing 15 OTs. The answer of the OT, if your answer of the OT goes correct, then you will get 2 marks. Otherwise, if the answer is incorrect or it is partially incorrect, either way, you will not be getting marks for that. And see, when it comes to your portal, um, on your portal, you are given with the scratch pad. I just accidentally closed it, but let me just open it once again. I'll show you the scratch pad once again. And either you are given with the loose extra sheet on which you will be doing the workings, which are essential for the sake of determining an answer related to OT or OT cases. But if this loose sheet is not given to you people, then you may carry out your working with the help of scratchpad. And it is not essential that you will have to do the working, or the working needs not to be produced in a specific way, because it is the answer which matters. If your answer is correct, you will get 2 marks. If your answer is not correct or maybe partially correct, both ways you will not be getting any score. But then why the loose sheet or the scratch pad is important? Because obviously, in order to arrive at a certain answer, you really need to do a little bit of the working. But that working is not going to be checked by your examiner. He will not have a look at whatever you have written on the scratch pad or whatever you have written on the loose sheet, because he says that with section A and section B, it is actually the answer which matters and not the working. But it is like quite opposite with section C, where workings are very important. Section C, which we have just done, if you will be like showing the workings, you will get the score appropriately and accordingly. But if you are just going to show the answer and you're not going to show the workings, for instance, if this chargeable gain is like straight away calculated and I do not show that how this chargeable gain is calculated, then I might not be able to get score for the chargeable gain calculation. So with section C, one really need to make sure that all the workings are to be done neatly, appropriately. Their working reference number should be given, and they will have to be presented appropriately in a manner that first you'll be showing the main format, and then afterwards vertically in the end you will be showing their relevant working. But when it comes to section A and B, the workings are not required, but obviously one will be dependent on doing a little bit of the workings in order to arrive at the answer. But for instance, if there is a student who is sharp enough and he doesn't use the working sheet or the scratch pad at all, and he'll be doing every calculation in his mind and producing an answer, and the point is, as long as the answer is correct, then yes, you will get 2 marks. So in section A and B, the answer matters and not the working. Okay, so this is basically the question that I have taken for you. These questions were once tested in by ACCA, and they are not now on the portal. But I believe that this is like a good source through which you may do the practice of questions. Okay, so the first question is that Junior received the following income for the tax year 24-25. His property income, I mean, the rental income is of 17250. The building society interest is of 18,000 and the dividend figure is of 16,000 pound. What is his tax liability for the tax year 24-25? So now, students, you will definitely have to use either the loose sheet, or if it is not given, then of course this is the scratch pad which you will have to open and do a little bit of the calculation. And if you are genius enough, and I should not say genius enough, but if in case you may do the calculation by not using either of the resources, then again, it doesn't matter that where did you do the calculation, whether your presentation was good or not. It is just the answer which matters. Okay, let me just do the calculation for you people. It's a very simple question, as 17250 should be mentioned under non-savings income column. Then under savings column, there is the building society interest figure of 18,000. And then we have a dividend figure of 16,000 pound. This is our total income. There is no qualifying interest payment. So I may also take it as net income as well. If you take a total of all these three incomes, this is quite low. This is not crossing the threshold of 100,000 pound. And well, it is ANI which decides whether the personal allowance is applicable or not. But as long as the net income is on the lower side, I believe ANI is also the same, because there is no gross gifted donation or personal pension contribution. So whatever the total of net income in this case will be, shall be taken as adjusted net income, against which I am going to deduct the personal allowance figure, which is preferably deducted against non-savings column. Okay, just tell me what is going to be the taxable figure for non-savings column. What is the taxable income as far as non-savings income is concerned? What would be the taxable income? Now, can you listen to me? Okay. So I was just saying that the non-saving figure has been completely adjusted in the basic rate band. And the saving income has got a taxable figure of 18,000 pound, which is going to be adjusted completely under the basic rate band. But do not forget that here we are going to apply the concept of starting rate band, which says that if your non-saving income is either not available, or if it is less than 5,000 pound, well, it is less than 5,000 pound, then whatsoever income from the saving which is being taxed, as far as as a part of first 5,000 pound of the taxable income of this individual, that will have to be treated over the starting rate, and well, the starting rate is zero. As far as first 5,000 pound of the income, overall income, is concerned, non-saving income has already used 4680 pounds, which would mean that how much of the capacity can still be found in the starting rate band, how much of the available how much of the figure is still available in the starting rate band, or in other words, how much of the saving income can still be counted amongst the first 5,000 pound of the overall taxable income for this individual, that's of 320 pounds. So on 320 pounds there is going to be no tax at all. This is going to be taxed over a starting rate of zero. And then this person, being a high rate taxpayer, first 500 pounds of savings will be taxed over a nil rate. And as far as the remaining income is concerned, that will then be adjusted in the basic rate band. As the overall savings figure was of 18,000 pound, out of which 320 and 500, they have already been taken into account, though their taxes were zero, but the remaining amount will now be taxed at an appropriate rate. I mean, whatever the rate existing in the basic rate band. So what that value will be? I think that value is going to be of 17,180 pounds. £17,180, on which basic rate shall apply. Well, basic rate for dividend is also 20%, so that would turn out to be a tax figure of £3,436. Now we are left with dividends, and I believe that dividend figure is not going to be adjusted completely into the basic rate band. As dividend figure is of £16,000, I just need to make sure that how much of the figure is still available in the basic rate band, as the basic rate band is of 37,700, out of which 4,680 and 18,000, I mean non-saving and saving, has been accommodated. Though you may say that we did not apply the rate on 18,000, rather £320 and £500 were taxed over a zero rate, but that does not mean that they did not consume the band. The band has still been consumed, but obviously the rate fell down to zero. Can you please tell me that how much of the figure is still available in the basic rate band? 37,700 less 4,680 less 18,000. How much of the figure is still available in the basic rate band? £15,020. All right, thank you. So 15,020. This will fall in the basic rate band, while how much of the dividend will fall in the high rate band, as the overall figure was of £16,000 for dividends, out of which 15020 will be adjusted in the basic rate band because this much capacity is still there in this band. So how much of the figure shall be falling in the high rate band? 16,000 less £15,020, 980. So this 980 will be falling in the high rate band. Okay, let's start applying the rates. First of all, I'll be applying the basic rate, but before that you start applying the rates, do not forget that in case of dividends, first £500 is also going to be taxed over nil rate. So out of £15,020, first 500 is going to be taxed over nil rate, while the remaining amount shall be taxed over a basic rate, which is in case of dividend is equal to 8.75%. So what would that be? 15,020 less 500 into 8.75%. Though we still consider that this £15,020 from the dividend is going to utilize the basic rate band all in all, but first £500 will be taxed over a nil rate. So this would be equal to 1270.5. I'll take it as either 1271 or maybe 1270.5. And then the remaining amount shall be adjusted in the high rate band, 980 being the leftover figure for dividends, and the high rate is 33.75%. So can you please tell me how much taxes, I mean, what is like going to be the result over here? This would be like 330.75. Okay. So now you need to see that what is going to be an overall tax liability for this individual in this case. What's going to be an overall tax liability? So according to you, the answer has to be 5973. We'll just have a look at the options. 5974 is the closest option available. And see, there must be a difference of like handling the decimal points, which is why there happens to be a difference of like 0.5 to 1 pound. So 5974 is said to be the correct answer, right? Okay, I'm just now give you people a question, and kindly read the question. The question is starting with Peter, and try solving the question as well, and do let me know as soon as possible that what is the appropriate answer as far as this question is concerned. Have you people determined the answer? According to you, that has to be 1960 pound. Let's see if that's the correct one or not. See, first of all, in the question, it is said that the asset was given to an employee for private use. It was a laptop computer. So, in the tax year 23-24, the use of asset benefit shall have to be calculated by multiplying the cost or first time market value, whatever is given, which is 3,800 into 20%. And this benefit for the tax year 23-24 had to be month apportioned as well, because the asset was given for the very first time for use on 6th October 23, which would mean that the asset has just been used for 6 out of 12 months. And then in the tax year 24-25, the employee was still using the asset. So once again, the benefit related to the use of asset shall have to be calculated by multiplying first time market value or cost, whatever is given, into 20%. And then exactly on the ending date of the tax year, I mean, exactly something which is relevant to the tax year, the transfer of this asset has been made. So it shall be treated as a transfer of second hand asset. And well, when second hand asset ownership is transferred, we need to consider two things. Let me just take you to the solution directly, as this is the use benefit for the tax year 23-24, and then for 24-25, that's going to be of 760 pounds. And then when the ownership of the asset was transferred, I need to see what the market value at the date of transfer is, which is according to the question is 1200 pounds. And then we need to compare it with market value when first given less benefits which have already been assessed. As already we have assessed 380 pounds and 760 pounds, so the remaining amount is of 2660 pounds. Now, what will we do? The market value on the day of transfer of asset, and market value when first provided less benefits which have already been assessed. We will pick up the higher figure, and the higher of these two figures is of 2660 pounds. Whether the asset is a first hand asset or a second hand asset, we will never apportion the value of benefit. But if any contribution has been paid at the time of transferring of the ownership of asset, that shall be deducted, and well, no such information is given. And then it is asked in the question that what is the overall benefit figure for 24-25. See, in this tax year, the asset has been used by an employee for which the benefit is 760 pound, and then the ownership is also given. Well, the benefit will become 2660 pounds. So altogether, the amount of benefit which has to be taken to non-savings income column is of 3420 pounds. So in this regard, 3420 is said to be the correct answer. Is this thing clear? All right. Then there is the third OT, which says that Mary is an employee of Counter Limited and is paid an annual salary of 75,000 pounds. She makes contribution of 5,000 pound into the company's occupational pension scheme each year. In the tax year 24-25, she drove 14,000 business miles in her own car, for which she has paid 50 pence per mile by Counter Limited. Now, how much employee class 1 NIC? By the way, what NIC employees have to bear? This is one primary, So basically, they're asking about one primary NIC which Mary is required to pay for the tax year 24-25. Well, employees will be paying NIC, one primary only, and that is paid on the value of earnings. And earnings primarily include everything that employee is receiving in the form of cash, which includes salary, bonus, commission, and all. So this value of £75,000 is definitely an example of earning. And to your surprise, there are two more things as well, which are also counted as earnings for an employee. Number one, if an employee is getting any cash or non-cash voucher, well, there is like no such information given in the question. And then if an employee is receiving approved mileage allowance for passenger, and that's also more than 45 pence per mile, then the excess value, I mean, the value which is found to be in excess of 45 pence shall have to be taken into account. See, Mary has got 50 pence, which is well more than 45 pence for business miles driven, and 14,000 business miles driven. And in case of NIC, we will not be like applying the typical rule of taking into account first 10,000 miles over 45 pence per mile and then remaining on 25 pence. It is just a comparison of how much an excessive cash an employee is receiving as a result of reimbursement of approved mileage allowance for passenger. So she is receiving 50 pence, which is more than 45 pence. So this is like 0.5 pence excess value, which she is receiving on the business miles driven. And that's how what her value of earnings will be. I mean, mileage allowance will be. I mean, this is like this is 50 pence per mile. So if you are just going to 50 minus 45 pence, or you may simply take it as point 0.5 pound against business miles driven. So that is equal to 700 pounds. So what is her overall earnings value? That is going to be of 75,700 pounds, right? 50 pence is more than 45 pence, 5 pence, point 0.05 pounds. Is that so? Yes. This has to be 0.05. Okay, so I did calculate it on the calculator and straight away multiplied it with 14,000. 50 pence is more than 45 pence. It is 5 pence extra, which is equal to 0.05 pounds. And well, that results into an earning of 700 pounds. So altogether 75,700. This is said to be the earning for Mary, on which we will be calculating one primary. Fine. Out of this 75,700, first 12,570 pounds. First 12,570 pounds will be assessed over zero rate, and then from 12571 till 50,270 pounds, I mean on next 37,700, we shall be applying the rate of 8%, and the earnings which are found to be in excess of this limit, overall earnings, out of which we have taken into account 12570 and 37,700. I mean, altogether 50,200 and 70 pounds has been taken into account. The excess value will therefore be the excess earnings are of 25,430, on which NIC shall be charged at the rate of 2%. So 37,700 into 8% will become equal to 3,016 pounds. And on excess earnings, when we'll be applying the rate of 2%, that would be of 508.6 pounds. I mean, you can take it as 509 pounds. So what is going to be an overall NIC class 1 primary which Mary has to pay? That is going to be of 3525 pounds. All right. So we shall type 3525 pounds. You are not going to put any comma, any full stop, any slash, any dash. No extra characters are required to be inserted when you are dealing with a blank area as far as your OT and OT cases are concerned. It is just the numbers that you need to crunch. Is this thing clear? Now we have another question. It says that Judy is provided with an accommodation by her employer, which the employer purchased 35 years ago at a cost of 74,500 pounds. The property has an annual value of 2,600 pounds and had a market value of 245,000 when first made available to Judy 8 years ago. Judy pays £250 a month to her employer to live in the property. The accommodation is not qualified as job related. So it's a non-job related accommodation for which benefit shall be calculated. Now, what is a taxable benefit for the tax year 24-25? See, whensoever an accommodation is provided and it's an employer owned accommodation, we will be taking into account the annual value. The annual value is always given in the question. This is of 2,600 pounds. And if the accommodation is said to be an expensive one, then we will be calculating an additional benefit. But here I will not be considering any additional benefit. Though the property is employer owned, and see, there is a gap of 35 years from the date it was purchased till the date it was provided to an employee for the first time, where we pick up the market value for the sake of calculating additional benefit, which is quite huge. It is 245,000 pound, but still I'm not going to take additional benefit. Why? Because in all such cases where the property is having an age of more than 6 years, we will be calculating additional benefit only where the property is originally an expensive one. I mean, where the employer has actually spent in the name of purchase price as well as capital expenses of worth more than 75,000 pound. And well, Judy's employer has just spent on the purchase price of the house, which is like a little bit lower than 75,000 pound, which is why as originally this property cannot be counted as an expensive one, which is why additional benefit is not to be taken into account. So what is going to be an overall value? This is 2,600 as the property has been used for the whole of the tax year, which is why I am not going to apportion the benefit. But Judy is paying £250 a month to live in the property, and we normally deduct the use contribution against the annual value, but here this 2,600 is also just the reflection of annual value. So how much of the contribution Judy is paying? She's paying £250 a month. She must have paid it for 12 months because – She seems to have used this asset for the whole year. So what's going to be the use contribution? What is going to be the use contribution? That must be of £3,000. And well, this is quite a surprising thing that despite the fact Judy is given with a free accommodation, she is paying more as compared to the annual value. So how much benefit she's receiving? Her benefit is zero. In fact, she's paying extra, but that extra treatment has nothing to do with tax implication. For instance, if she has paid just £300 in total, then £300 would have been deducted against £2,600, and the remaining value of benefit shall have been taken into account. But where the contribution would crossing the benefit value, then the benefit will be reduced down to zero. So in this case, what the benefit will be, that is zero. Clear? Now we have another question which says that during the year ended 31st March 2025, Blue Cheese Limited, it's a company, by the way, they purchased a second-hand machine for £100,000. The old machine was disposed of during May 24 for £10,000. The old machine originally cost £90,000 and the super deduction was claimed when it was purchased. On 1st April 24, Blue Cheese Limited had a tax written down value brought forward on the main pool was £43,000. Let me take you to the solutions directly. First of all, WDV brought forward for the main pool is £43,000. And then the company had acquired a second hand machine for £100,000. Whenever you're going to acquire any plant and machinery other than car, they will qualify for AIA. But would that be eligible for enhanced capital allowances? Well, my answer is no. Why? Because it's a second-hand machine, and if the asset is said to be a new one, then they would qualify for enhanced capital allowances. So this is like going to be treated in a normal way, where first of all we'll be applying AIA, and if any value is gonna be left behind, then it will be included in general pool where WDA at the rate of 18% shall have to be applied. Okay, but this £100,000 is going to be covered completely against AIA. So nothing is like going to be included in the main pool. And then it is also said in the question that there is a disposal of a machine, an old machine, for £10,000. The machine had originally cost £90,000 and super deduction was claimed on it. And now I need to see that where this machine was originally taken into account. I really want to know that whether at the time of its acquisition in the past, was it included in main pool or special rate pool? What do you believe? See, as no specific information regarding its location given, so I believe it's a simple machine which I believe that generally when machines or equipments are acquired, they are to be taken to general pool. So I may say that in the past, a machine was acquired and that old machine was costing £90,000. It was eligible for super deduction, and we do not know that what had been the treatment in the past. But now, as that old asset is being sold, I need to see that what is the disposal figure. The disposal figure is going to be straight away treated as balancing charge. So this is like going to act negatively against our allowances value. See, this £10,000 is going to be taken straight away in the form of balancing charge. Now with main pool as £43,000 is the WDV brought forward. On this, we shall be applying WDA at the rate of 18%, which would result into an allowance figure of 7740. And well, AIA is of £100,000. So altogether, what is going to be our overall allowance figure? This is of £97,740. Is this thing clear? All right. Now we have another question in front of us. It says that Dove Limited, again, this is the case for company because whenever you find the word of LTD or PLC, I mean private limited or public limited, that would mean that this is the case of company being discussed over here. So Dove Limited has got one associated company. So there are two companies in the associated group. Our corporation tax slabs will be affected, and of course, when we need to determine that whether the company is said to be a small or medium sized company or even a high or even a large size company, this associated company presence will also matter. So this associated company name is Crow Limited and has the following results for the 9-month period ended 31st of March 2025. So company, as they do the calculation according to an accounting period which could be of 12 months or even shorter than 12 months, and here the Dove Limited has made accounts for 9 months period, which is clearly less than 12 months. All right. So the first thing would be their trading profit figure is of 40,000. The chargeable gain figure is of 20,000 and dividends are of 12,000. I shall not take dividend into corporation tax calculation. And this dividends are taken from associated company, though the dividends are never taxable whether they are being received from a company in which shareholding is found to be greater than 50% or less than 50%. I mean, whether they are being received from an associated company or not an associated company, but at least the dividends that we receive from non-associated company shall be taken into account in order to determine the augmented profit. And this is the augmented profit which determines the rate of the tax, though the rate is applicable on taxable total profit. All right. So the trading profit figure is of £40,000 and chargeable gains figure is of £20,000. The dividends are not to be taken into account. So what's going to be the profit? This is going to be of £60,000, right? This is said to be the taxable total profit as there is no qualifying charitable donation even given in the question. Now we shall be applying the rates and the slabs are 1 up till £50,000. We tend to apply, see, this is like according to Finance Act 24, we tend to apply the lower rate of 19%, but this limit is subject to change where the accounts are made for less than 12 months or where there is a presence of group company. This limit is going to be changed, and well, in this case there is a presence of group company as well as the accounts have been made for a period of less than 12 months. So on the basis of these two things, the profit slabs are going to be changed. And it is up to you whether you are going to change it according to group number or according to the months existing in an accounting period. Well, I'm just going to divide it over two as there are two companies, Dove and Crow Limited, in the group. So this would become £25,000. And this limit is going to be changed further with respect to the period of as it does contain only 9 months. Could you please tell me that where this slab would come to an end? 25,000 into 9 by 12, that shall be equal to what? 18,750? All right, thank you. So 18,750 is said to be the lower limit. The second slab shall start from 18,751 and it ends on £250,000, but this higher limit is subject to change as well. So it's like I'm going to divide it over two and then it is going to be month apportioned as well. So the higher slab would end on, I mean, the upper limit will be of 93750. Thank you so much for updating me. So 93750. This is the lower limit being 18,750 and 93,750 being the upper limit. And you could see that the taxable total profit is 60,000 pound. We add dividend received from non-associated company to figure out what an augmented profit is. Though we receive the dividend, but this is not from this is from associated company, so it is not going to be taken into account to determine augmented profit. And well, taxable total profit is going to be straight away taken as augmented profit. And augmented profit, though here both augmented profit and taxable total profits are considered to be same. This is like found to be in between this limit. So I'm going to apply the rate where we will be applying the high rate on taxable total profit first, and then the marginal relief shall be taken into account, which includes the upper limit. Here the upper limit is of 93,750 less augmented profits, which is in this case of 60,000 pounds, into taxable total profit over augmented profit. Well, taxable total profit and augmented profit are same, so they need not to be taken into account, into 3 by 200. Okay, just tell me step by step what is equivalent to 25% of 60,000 pounds. 25% of 60,000 is, I believe, 15,000 pounds. All right. So this is like said to be 15,000 pounds. And then marginal relief figure. Could you please let me know what the marginal relief figure is? 506 pounds. Thank you. So after getting a relief of 506, how much tax liability Dove Limited will have to pay with respect to its accounting period of 9 months? That is going to be of 14,494 pounds. So this option C is correct, right? Is this thing clear to each and every one of you? Okay. So here comes MCQ number 7, which is related to VAT. It says that Sheila is registered for VAT for the quarter ended 31st of March 2025. As for quarter for 3 months, usually the VAT calculation is done. The input VAT incurred on her purchases and expenses include the following. Okay, so as far as entertainment expense is concerned, keep one thing in mind, and be very careful that when the question is about adjusting trading profit, entertainment expense is typically disallowed, whether the entertainment is given to local customers or suppliers, or it is like gonna be given to overseas customers and suppliers. But for VAT, the rule is a bit different, as when the entertainment is given to overseas customers, that's the entertainment on which paid figure of VAT is recoverable. And see, this is not the expense figure, this is the VAT figure on whatever the expense value is, but this is 620 is the value of VAT. So this is like recoverable. Then purchase of new office equipment. See, whensoever the business is going to acquire anything for the sake of business purposes, the related VAT is recoverable. So I believe 1550 is also recoverable alongside 620 pounds. And then the new car is purchased, and we need to take a stop over here, because whensoever any car is purchased or any capital expense is incurred on the car, the related VAT payment is not recoverable at all. So how much of the VAT is recoverable? It is 620 plus 1550 pounds. So together it will become 2,170 pounds. This much VAT is recoverable by Sheila with respect to the quarter ended 31st of March 2025. Is this thing clear? Then we have MCQ number 8, and this OT is once again relevant to it says that Destiny is registered for VAT and calculates her VAT liability based on the flat rate scheme. Flat rate is like the fixed rate which is applied on the overall gross figure of sales made in the quarter, though um, the flat rate is decided according to the nature of the business, but you need not to remember any of the flat rate because flat rate percentage will always be given to you people in your exam. The relevant flat rate percentage for Destiny's business is 12%. Now, for the year ended 31st March 25, Destiny's sales exclusive of VAT were, so this is like net values. Standard rated sales is of £45,000, zero rated sales is of £25,000, and exempt sale is of £8,000. Under normal circumstances, exempt sales are not eligible for VAT. Zero rated sales are charging zero. I mean, again, no VAT is like being charged to the customers. But when it comes to standard rated sales, on this value, 20% of the VAT will be charged over the selling price. Can you please tell me what actually becomes equivalent to 20% of £45,000? 20% of £45,000 is equal to £9,000. So that would mean that when the sales, standard rated sales were being made, 45,000 and 9,000 altogether, £54,000 was being collected from the customers. I mean, even practically right now, we must be selling off the product and we must be charging 54,000 to the customer. But then either the same amount of VAT which we have recovered from the customer shall have to be paid back to HMRC, or if flat rate percentage, a flat rate scheme is being applied, then instead of like paying the original amount of VAT collected from the customer, we shall be applying a standardized rate over the on the overall sales value. So as it is said that the Destiny is now going to decide that how much of the VAT is going to be payable. First of all, I am going to take the total of all sales, and that's also that figure which is the gross one. As with exempt sales, of course, we couldn't have charged any VAT with zero rated sales, though these are the taxable sales, but it is, I mean, that's the rule that we will not be charging VAT from the customers. So the so the sales figure is of 25,000. But what exactly actually the amount we have collected from standard rated supplies, 45,000, and the actual VAT rate is always to be charged to customers. Customers are not charged the flat rate. Customers are always charged with the VAT percentage, which is like applicable according to the type of the supply, according to the type of the product or the services. But it is the business which will then decide if they if they fulfill the conditions, that how much of the VAT will they be paying to HMRC, either the same amount of the VAT which they have got from the customers, or they will be applying the flat rate. Okay, so what amount of sales are the gross amount of sales received from the customer is of £54,000. Now I'm going to determine what is the overall gross value of sales is. This is going to be of 8,000 plus 25,000 plus 54,000. 87,000 pound. Thank you. And on this gross value, I shall be applying the flat rate. And what the flat rate is, as it is always given in the question, according to which it is 12%. So what is equal to 12% of 87,000 pound? That must be 10,440 pounds, right? So this is the amount of VAT which Destiny shall be paying to HMRC. If you want to compare, then they are collecting less as compared to what they have to pay. So additional burden is all being taken up by Destiny, I mean the registered seller. But sometimes people are inclined to pay more by just looking at the ease with which they could do the VAT computations. Sometimes people say that with every quarter we will have to hire, sorry, special people who know how the VAT liability is to be calculated, but it is like very simple to compute the VAT. So we may save the amount which is otherwise payable to VAT accountants. We'll be like, we will be simply taking up the total of gross sales and then we'll be applying the flat rate percentage. So the ease, the comfort that we are getting, if we have to pay any amount additional to HMRC, that is still worth it, right? So which option is correct? 10,440 pounds. Now there is another question which says that Richard acquired a holiday villa, a residential property for 125,000 pound on 1st May 2014. He gave it to his wife Rose on 30th September 19. I mean, this has happened back in the tax year 1920. But when there has to be a transfer in between husband to wife, I mean, in between spouses, then in the tax year 1819, no calculation was required because the transfer was made at no gain, no loss basis. Okay, now the villa is with his wife Rose, and in case of spouses, the recipient spouse shall acquire the asset over the same cost for which the asset was originally acquired by the first spouse. So it is like 125,000 pounds shall have to be treated as the cost for Rose, though at the time when it was shifted to her, it had got a market value of 100,000 pound, but that's not the case as far as transfer in between spouses are concerned. Now she sold the villa for 175,000 pound in July 24. I mean in the current tax year 24-25, and the villa has never been the couple's main residence, so don't think about applying principal private residence relief. And the Rose had no other capital disposals in the tax year 24-25, but she has brought forward capital losses of 11,000 pound. Okay, her taxable income for the tax year 24-25 is of 30,000 pound. But why are they telling us about the taxable income? Taxable income, taxable amount is something which shows that whatever the employment income, trading profit, rental income, I mean, whatever the taxable sources through which she is receiving an income on which she is liable to pay income taxes. But what is the point of describing this amount? I mean, mentioning this amount over here at the point when they are demanding us to calculate her capital gains tax liability. Why did they tell us that what her taxable income is? What is the reason? Any idea? Why the information related to taxable income given in this question? See, taxable income tends to use our tax bands first, be it the basic rate band, higher band, or the additional rate band. And whatever the band is left unconsumed, that will then be used for the sake of computing CGT liability, which is why they have told us about the value related to taxable income so that we may decide that what band is still existing in this case, right? Mm, mm. Now, first of all, I'm going to calculate the gain for Rose as she has made a disposal in the tax year 24-25. The disposal value is of 175,000 pound. The cost is the same cost which used to be the cost of rigid, £125,000. What is going to be the gain for Rose? That is of £50,000. Against current year gains, as she has no other gain, the only gain is of £50,000. We need to deduct current year capital losses, if any, and there is like no capital loss in this case. Then annual exemption is deducted, and then brought forward capital losses are to be deducted, which are of £11,000. And finally, we will be able to come to know what the taxable gain for this individual will be. This is going to be of £36,000, right? So this is the gain on which CGT liability shall have to be calculated. If this gain is going to fall in the basic rate band, then the rate will be 18%. Otherwise, if the gain will be falling in the high rate band, then the rate of 24% shall apply. But it depends what the taxpayer's status is, as they have said that her taxable income, I mean the income related to non-saving, saving and dividend after the deduction of personal allowances is of £30,000. It suggests that the basic rate band has not been consumed completely. The basic rate band is of 37,700, out of which £30,000 has been consumed. So how much of the value is still left? The leftover basic rate band figure is of £7,700, right? Okay, so gain figure is of £36,000, out of which 7,700 will be taxed at the rate of 18%, while the remaining gain, 36,000 minus 7,700, the remaining gain figure is, I believe, 28,300. This is going to be taxed at the rate of 24%. And that's how now we may see what the tax liability will be over the basic rate. The tax figure turns out to be 1386. Just confirm these figures as well. And then 6792 is the high rate tax figure. So altogether, what is going to be the tax liability? £8,178. £8,178 is said to be the capital gains tax liability, or you may also call it as capital gains tax payable. Again, when the blank is given, do not write any extra character, just put the number. So it is £8,178, right? Is this thing clear to each and every one of you? All right. Now we have one more OT. It says that Brandon bought 30 hectares of land on 1st March 2017. On 1st March 2019, he sold 10 hectares of land for £150,000. See, this has happened on 1st March 2019. I mean, back in the tax year 1819. At this time, the remaining land was worth £250,000. On 1st January 2025, I mean, in the tax year 24-25, Brandon, you need to identify his chargeable gains and the due date for the capital gains tax payable thereon. The options are there in front of you. Could you please take a minute and let me know that what your answer will be? Do update me once you're done with the solution of this. You think that's C and D? Okay, let's see what the answer is. Okay, so first of all, as back there in the tax year 1819, few of the hectares are sold, though they are demanding the calculations which are prevailing right now. But obviously, when the past data is given, you will have to solve what has happened in the past because this must be affecting on the current transactions. So back there in the tax year 1819, when Brandon's 10 hectares related to 10 hectares, as the part disposal cost could be determined with the help of part disposal formula, which is market value of sold part. As now I'm talking about these 10 hectares being sold, they were having a market value of £150,000 divided over market value of sold and unsold part. At that time, when 10 hectares were sold, the remaining hectares had got a market value of £250,000. Could you please tell me that how much of the cost is associated with 10 hectares, as the overall cost figure is of £300,000? So £300,000 into market value of sold part divided over market value of sold and unsold part. Please tell me how much of the cost is associated with 10 hectares of land. I mean, the disposal which happened back in the tax year 1819. 112500. Thank you. And once these 10 hectares were sold, I need to see that how much the cost is still left, because 30 hectares were having a cost of £300,000. 10 hectares are sold, and I have determined their cost. Brandon has only 20 hectares and their cost is equal to, I believe, 187,500. 1,857,500 is said to be the cost for 20 hectares. And right now, all the remaining hectares, I mean 20 hectares, have now been sold for 425,600. Now I'm just going to calculate the gain. Right now, I do not have to apply the part disposal because whatever the 20 hectares were left behind, they are going to be sold all in all. So why would I be like extracting a further proportion of the cost, because this is like going to be now completely sold. The disposal value is of 425,600 and the cost for these 20 hectares is of 187,500. So what is going to be the chargeable gain in this regard? That must be of 238,100. So 238,100 is said to be the chargeable gain. And as this asset is being sold on 1st January 2025, I mean in the tax year 24-25, the respective CGT liability shall be due on 31st of January after the end of the tax year. This is the normal due date for the payment of taxes. Though when residential properties are sold, then the due date is changed. So it is like going to be of 31st of January 2026. 31st January 2026 and 238,100. So option D is correct. All right. Now quickly moving towards 11th OT, which says that Bruce died on 16th of July 2024 and he made one lifetime gift on 10th November 2019 into a discretionary trust, the lifetime tax of 52,250 has been paid and the gross chargeable transfer value, I mean GCA, was 586,250. This is the best thing. You are told that what the lifetime IHT is and what was GCA. You can either call it as GCA, the gross chargeable amount, or you may also call it as gross chargeable transfer value. And now they are asking that what is like going to be the death IHT because Bruce died on 16th July 24, which is falling in the tax year 24-25. So the first step towards calculating GCA, first step towards calculating death IHT on lifetime transfer is to determine GCA, and well, it is given in the question. It is of 586,250. And then we are going to deduct NRB. NRB with respect to the year of death shall be taken into account. It is of 325,000 pound, but it needs an adjustment for the chargeable transfers made in 7 years, and 7 years are always taken prior to the date of gift. So back from 10th November 2019, I need to see how many transfers, chargeable transfers are made in the last 7 years because their GCA is important and they're going to reduce NRB. I believe that no further information is given in the question, so no transfer was made in the last 7 years. So whole of the NRB is still available. Okay, after deducting 325,000 pound, could you please tell me how much value of this asset will be left behind, which we call as taxable value? 586,250 minus 325,000. 261,250. On which death IHT on lifetime transfer shall have to be calculated, and they are always calculated at the rate of 40%. And death IHT is something which is always payable by donee of the asset, which is in this case the trustees of the trust. Well, IHT on death estate is payable by executor, though the sufferer is residual legatee. So 261,250 into 40%. What comes out? It's of 104,500. Okay, once you have applied the rate, now think about taper relief. For that, you need to count the years. The date of gift is 10th November 19 and Bruce died on 16 July 24. So you need to see that how many years have been elapsed. It's like 10th November 19 to 10th November 20. That will be making 1 year. 10th November 21, 22, 23, and that is it. So more than 4 but less than 5 years are gone. The taper relief in between 4 to 5 years shall have to apply, which is of 40%. So 40% is being tapered off. 104,500 into 40%. Can you please tell me what that value is? 41800. And then how much of the value is going to be left behind? 104,500 is going to be tapered down by 41,800. So they are left with 62,700, against which we need to see that if any tax has already been paid in the lifetime, this is going to get deducted in order to see what the final figure of tax is now payable. As 52,250 has already been paid in the lifetime, so it's only the remaining amount that shall be payable to HMRC, which is called as death IHT on lifetime transfer. Could you please tell me what the remaining value will be? That's of 10450. So 10450. So first option is correct, right? Is this thing clear? Are you all getting this point? Right. Then we have OT number 12. It says that Brian died on 11th December 24 and left an estate worth 1,276,000 to his daughter. Estate would mean anything which was not distributed in the lifetime of the donor, and then the person died, and eventually his things are going to be distributed. This is not a lifetime transfer. This is the transfer upon death, which is why death estate computation shall have to be carried out. And every asset which is still not distributed till the date of death shall be included as a part of death estate pro forma over their market value, except for insurance, which is taken on the basis of proceeds. So the estate is having a worth of 1,276,000, and Brian's main residence valued at £300,000 is also included in this total value of 1,276,000. And see, if the death estate contains a main residence which is gonna be received by direct descendants, as in his daughter is direct descendant, so our NRB, the residence delivered band, will also be available. And he had made a transfer to his sister already on 18th June 2019 worth £220,000. How much inheritance tax is payable on Brian's death estate? Right. So this is the transfer which has happened in his lifetime. This is the lifetime transfer. And this was made to his sister in the lifetime. And lifetime transfers are categorized as either PET or CLT. As it was given to an individual, so it is called as PET. And 220,000 was the transfer of value. It is not eligible for small gift exemption. Not even a marriage exemption is available. Not even the marriage exemption is available, but annual exemption for the current year, 1920, and the previous year, 1819, shall be available, as annual exemption figure is of £3,000 for each year. So for 2 years, the annual exempt amount is of £6,000. So chargeable amount of this gift is of £214,000. And well, in case of pet, whatever the transfer of value after exemption is, or we also call it as chargeable amount, shall be treated as gross chargeable amount. But why am I calculating even this value of 214,000, since they did not ask me to calculate any IHT in respect of lifetime transfer? See, when I'll be calculating IHT on Brian's death estate, NRB shall have to be used, and NRB is affected by any chargeable transfer made in the last 7 years, right? So, which is why I had computed the chargeable amount, because in case of PET, the chargeable amount shall be treated as gross chargeable amount, because though when it was given in June 19, it was a PET, it was exempt. But then I believe within 7 years, Brian died. So this asset must become a chargeable one as a result of Brian's death. But though they haven't asked us to compute death IHT on lifetime transfer right now, but still I need to know its gross chargeable figure, because that would be affecting our NRB while calculating IHT on death estate. Okay, I'm just going to quickly show you the solution. 1,276,000 is the overall estate value. Against this, we are going to deduct NRB. NRB of the year of death will be picked up. It is of £325,000. And then the GCA of the transfers made in the last 7 years shall be deducted. This is exactly the same value which we have calculated, 214,000. After deducting it, the remaining NRB is of £111,000. And it is not just the NRB, but RNRB is also available. Why? Because Brian's death estate includes his main residence, which is gonna be received by his direct descendant. So residence related band will also be given. Now, the value of the main residence is £300,000, and he himself can be able to claim RNRB. I mean, he himself is not going to claim, but his personal representatives will be able to claim RNRB of £175,000 on his behalf. And we will not be thinking about any unused NRB or RNRB of Brian's spouse, because no such information about her is given in the question. Maybe he doesn't have a spouse. Maybe the spouse is alive, which is why no information is given, because if the first spouse is dead, then its unused value of NRB as well as RNRB could also be utilized. Okay. So 175,000 is the value of RNRB, right? 1276000 is the value of estate. NRB is of 111,000 pound. The leftover NRB is 111,000 pound, and RNRB is of 175,000 pound. And then how much of the value is gonna be left behind? This is the value on which IHT on death estate shall have to be charged. So that's going to be of 990,000 pounds. Thank you. And 40% of this will be equal to 396,000 pound. And against IHT on death estate, we shall never be applying taper relief, because these are those things which are being gifted at the point of someone's death. There is like no gap in between the date of gift and the date of death, right? So 396,000 pound is said to be the answer. Again, this is the value to be placed in the blank. So it is just the number which I shall be considering. Okay. Now we have one more OT, as there are 15 OTs in section A. And obviously this is like taking a comparatively more time, because obviously not just I am solving the question, but I am trying to give you the facts, and I am just trying to revise the rules a little bit as well. So it must be taking time. Then the next OT says that which of the following statements concerning self-assessment tax return for the individual is true. Kindly have a look at the possible answers. Look at the options, and then I'll let you know that which option is correct. In fact, you need to tell me first that according to you, what has to be the correct option. So, according to you, which option is correct? First and fourth? Is my voice audible? All right. So I was saying that option number one and two are not true at all, because whether HMRC is going to give you a notice to file your return or not, it is your moral duty to file it anyway. But the third option says that all individuals who submit a tax return on time are able to have their tax payable calculated by HMRC. Yes, whenever you do not know that how the tax liability could be computed, as long as you're going to file your return, I mean submitting your tax documents on time, then HMRC will definitely be calculating tax liability on your behalf. So it is option C which is correct. Then there is the second last OT, which says that for the tax year 23-24, Kai filed a paper self-assessment tax return on 10th August 24. I hope you remember that paper-based return shall be filed by 31st of October after the end of the tax year. And what is the deadline for Kai to make an amendment to his tax return for the year 23-24, and by what date will HMRC have to notify Kai if they intend to carry out a compliance check? So, first of all, if I talk about the tax year 23-24, paper-based return has got a due date of 31st October after the end of tax year. So, this shall have been done by 31st October 24, and this is a great thing that they have filed on time. Afterwards, if a taxpayer would want to make an amendment to the return, this could be possible, and that should be done within 12 months after 31st January following the end of tax year. So for the tax year 23-24, despite Kai had filed paper-based return, but the reference period is always measured from 31st of January. So after this 31st January would appear on 31st January 25, after which individual has got 12 months to make changes, which is in this case would be completed on 31st of January 26. So 31st of January 26 is set to be the time period within which Kai can make changes to the return. And considering they have filed their return on time, and what the actual filing date is, it is 10th of August 24. HMRC may inquire into the return, and HMRC has got a time period of 12 months after actual filing date. So if 10th of August 24 was the actual filing date, then 10th of November 2025 is the date by which notice to inquire into the return should be served by HMRC. So it's like 10th August 25. So which option is correct? That is option B. Is this thing clear? Now we have the last OT, which says that Gilbert's tax liability for the tax year 23-24 and 24-25 are as follows. C, this is the data for 23-24, and this is the data for the current tax year. What payment on account will Gilbert have to make on 31st July 25 in respect of his tax liability for the tax year 24-25? So when it comes to the tax year 24-25, the second payment on account is basically something which is due on 31st July 25, and normally it is based on previous tax year's tax payable and NIC4 figure. But could you see that what the situation for the previous year is? In the previous year, the income tax payable is just 300, NIC4 is 320. It is extremely low. And if a previous year's tax payable and NIC4 is found to be of not more than £1,000, then there is no obligation to pay either the first payment on account or even the second payment on account which is being asked in the question. Then how the tax for the tax year 24-25 will be paid? if the whole amount is like going to be paid in the form of balancing figure, which is going to be due on 31st of January after the end of the tax year. So when it comes to the fact that how much of the payment on account is going to be due as far as second payment on account is concerned, then the answer is zero. Is this thing clear? Now, we have section B. We'll try to deal with all of the questions of section B, but if something couldn't be covered, then I'll be sharing the solutions with you people. In section B, we will be having 3 OT cases. Every OT case will be carrying 5 OTs, and the OTs are being tested on the same design as what we have seen in section A. With 5 OTs, each OT will be carrying 2 marks. So every OT will be altogether is of 10 marks. So section B grand total is of 30 marks. Again, here, whether you do the working or not, your working doesn't matter, but your answer would matter. If your answer is correct, you will get 2 marks. If your answer is either totally incorrect or partially incorrect, either way, you will not be getting a score. Again, I'm repeating the fact that with section A and section B, answer is important and not the working. Examiner is not interested in whether you have done the working appropriately or not, whether you have made the working on scratch pad or on the loose sheet, or altogether did you do any sort of working at all or not. But when it comes to section C, then the working becomes the most important thing. Your steps, your presentation, your working, that all matters. Okay, so this is basically the first OT case right there in front of you. Kindly start reading the OT case and then I'll discuss the OTs associated with this OT case. I hope you people must have gone through the question completely. Now, the first question says that which of the following statement is true concerning inheritance tax exemption for lifetime transfers? And you are having these 4 options. This is the general question. So, according to you, what option should be correct? What would be the correct option as far as lifetime transfers are concerned? It is the third option which is correct, that a gift in consideration of a marriage from an individual parent siblings like your uncles and aunts, that is exempt up to £1,000, because there is a standard limit set for grandparents, for parents, and the party to the contract. The rest of the people, if they are giving any asset as at the point of marriage, then the exemption figure is of £1,000. Then there is a second OT which says that what is the total amount of IHT exemptions that can be deducted from the transfer from Thomas to his niece on 12th April 2017. So 12th April 2017 is basically the gift when Thomas is basically the date on which Thomas made two gifts during his lifetime. And the gift that he gave to his niece on her marriage was £9,000. And they are specifically asking about this gift only. If £9,000 is the transfer of value, as small gift exemption is not available, but then we need to think about marriage exemption. As from someone else, if the gift is like gonna be transferred, then a marriage exemption of £1,000 will be available, right? So £1,000 is the marriage exemption. And then the annual exemption for both the current year as well as previous year. As annual exemption amount is of £3,000 for a year, so for 2 years that's going to be of £6,000. So this is like going to be available. So altogether, how much of the exemptions are available in this case? It is of £7,000, right? So in this regard, which option is going to be correct? That is of £7,000. Is this thing clear to each and every one of you? Then we have third OT, which says that how much lifetime IHT was payable on the gift to trust on 2nd September 2017. Now, let's have a look at the transfer made to a trust on 2nd of September 2017, where the gift had a worth of £400,000 and he, being a donor, had paid lifetime tax on it. So first of all, we need to take into account the transfer of value, which is of £400,000. It is the gift being given to a trust, so that's called CLT, and it is given on 2nd September 17, and this would be like falling in the tax year 2017-18. Though small gift exemption is obviously not available, and neither the marriage exemption, because this is the gift given to trust, but then we need to deal with the annual exemption. And now, what do you think? Will the annual exemption be available in this case or not? See, like few months before in the same tax year 17-18, a gift to niece has already been given and it has consumed annual exemption for both of the tax years. So that would mean that annual exemption is no longer available. So whole of the value is going to be taxable, on which lifetime IHT and lifetime transfer shall have to be calculated, right? So this is like said to be the chargeable amount of gift, on which, first of all, I'll be applying the nil rate band. The nil rate band of the year of gift is of £325,000. Though this £325,000 needs to be adjusted for the chargeable transfers made in the last 7 years. But as you could see in the question, that no transfer has been made in 7 years prior to the date of gift, which is a chargeable one. So the remaining amount will be considered as a taxable value of gift, on which lifetime IHT shall have to be calculated by applying the rate of obviously 25%, because in the question it is said the donor has decided to pay off the taxes. So 25% of £75,000 will be equal to what? This is going to be equal to 18750, because whensoever the donor will decide to pay off the taxes, the rate of tax will become 25%. Or you may think that the gift itself is presenting 20% and the rest 20% is the amount of gift. So the net value is either going to be multiplied with the fraction of 20 by 80, or you're going to multiply uh, the rate of 25% on the taxable value of gift in order to determine the amount of IHT which is to be paid by donor. So the tax value is of 18,750 pounds, right? Is this thing clear? All right. Then we have next OT, which says that what is the total nil-rate band available while calculating the IHT on Thomas' death estate. Now, as Thomas died on 11th January 2025, which is falling in the tax year 24-25, we need to see that how much of the NRB is available. Let me take you to the solutions directly. See, as NRB of the year of death is of 325,000 pound, we need to make an adjustment for the chargeable transfers made in the last 7 years. Well, though we always check 7 years prior to the date of gift, but in case of death estate computation, either you call it as a date of gift or the date of death, that would mean the same thing. So 7 years prior to the date of death shall be taken into account, and no gift, no chargeable gift is like falling in 7 years prior to the date of gift. And then, as it is mentioned in the question that Thomas' wife is already dead and she herself had not been able to use her nil-rate band. Her unused nil-rate band was of 62,400 pound, and when she died, the NRB was of 312,000 pounds. So we need to see that how much of the NRB was left unused. If she was left with 62,400 out of 312,000, that means that she did not use 20% of her nil-rate band at the point of her death. And if there is like said to be any unused NRB as a result of first spouse death, then the unused value will be used against death IHT as well as death estate computation at the point of second spouse death. So when Thomas died, 20% extra NRB with respect to his current value of NRB shall be given to him, which is of 65,000 pound. So altogether his NRB and unused percentage of NRB, which is applied on the current existing value of the NRB, that is of 65,000 pounds. So altogether he will be eligible. I mean, his executor, personal representative will be able to claim an NRB figure of 390,000 pounds. So 390,000 pound is said to be the correct option. Then we have the last OT related to this OT case, in which it is said that what is the total available residence nil-rate band while calculating IHT on his death estate if relevant election is made. So when he died, and if he had a main residence as a part of his death estate computation, then and it is like gonna be given to the direct descendants, I mean either to his children or grandchildren, then our NRB is obviously claimable. See, his death estate had got a house worth 300,000 pound, but he had taken a mortgage of 60,000 pound on it. So technically the value of the house which was included as a part of his death estate computation was of 240,000 pound. Now when Thomas died, um, his RNRB will be of 175,000 pound, and if any RNRB has been left unused by his spouse, that is also usable. As no information about RNRB related to his spouse Sarah is given in the question, that would straight away mean that the first spouse is already dead and she has not made use of RNRB, of her RNRB at all. So it's like Thomas' own RNRB is of 175,000 pounds and Sarah's RNRB is of 175,000 pounds. So altogether, he has RNRB of £350,000, but wait, as the value of the residence which is going to be included as a part of his death estate computation is of £240,000. Well, nobody can claim RNRB of more than the value of main residence. So their RNRB is restricted to £240,000. So which option is going to be correct in this regard? That is of £240,000. I hope you have understood the whole concept clearly. Now we are going to have another OT case. This is the OT case related to capital gains taxes. Kindly start reading the OT case and then I'll discuss the OTs related to this case as well. So here comes the first OT. What is the net chargeable gain on the disposal of Williams' sole trader business on 30th June 24 that qualifies for business asset disposal relief? Means when an individual is going to dispose of either his business completely or substantially, then their gains and losses are first calculated and then they are going to be netted off against each other. And then we determine that how much of the gain will be eligible for applying BADR. But there could be a chance that when the business is sold, there might have been any asset which is like being used for non-business purposes. And well, that asset's gain shall not be taken into account because BADR is only applicable over the gains related to the business assets being used for trading purposes. And the biggest concern over here is that the business being sold must have been kept for a period of at least 1 year prior to the date of disposal, because must have been kept for 2 years prior to the date of disposal, because this is the rule that any asset which wants to be qualifying for BADR, they have to be owned by the sole trader for 2 years prior to the date of disposal. And we will not be counting that whether each and every asset of the business was fulfilling this 2 year condition or not. The business itself shall have been run for 2 years and not their individual assets. So they have already calculated the gain. The gain related to goodwill is of £60,000, while the gain related to factory freehold property, sorry, is of £64,000, and the storage unit is sold for £13,000, and the complete business is sold, and these all assets were being used for business purposes. See, the business is being run since 1st of January 2020. So the 2 year time limit condition is being fulfilled as well. Though if we see that the freehold property, this asset only has just been used for 6 months prior to the date of disposal, but nobody has to look at the individual asset. Rather, the dates related to the complete business ownership are to be taken into account. But yes, when shares in a personal company are sold, which means that the company where the shareholding is either equal to or more than 5%, and the person is said to be an employee in the company as well, then upon the disposal of such company's shares, the BADR shall have to be applied as well. Both the ownership as well as employee status has to be kept for 2 years. I mean, shareholding has to be retained for 2 years prior to the date of disposal, and he has been an employee, whether part time or full time, for a period of 2 years prior to the date of disposal as well. So, this is like something a different criteria. So, this whole gain and loss figures shall be taken into account. 60,000 plus 64,000 minus 13,000. That's going to be equal to, I believe, 111,000. So this is the value which will qualify for business asset disposal relief. This is the gain on which CGT rate of just 10% shall have to be charged. Right? Now we have second question. What is the allowable cost used in the capital gains tax disposal computation for the sale of the 2 hectares of land by William on 3rd August 24? So I just need to see that what is the cost related to the disposal of 2 hectares only. Again, we shall be applying the concept related to part disposal formula. You can see that William had actually acquired 3 hectares on 4th August 2011 for 19,500 pounds. And technically, he acquired the asset as a result of the inheritance when his father died on 17 June 2019. Um, See, when such complicated issue is given and a lot of dates are given, you will have to keep on resolving the issue by taking the earliest most date first. So the oldest date given over here is 17th of June 2019 when William's father died. And at that point, these 3 hectares were inherited by William. And in this case, the probate value, I mean, the market value at the date of death shall be taken as cost for the person who is the donee, who is the recipient of the asset. And well, then he had to incur £500 being the legal fee over like defending his title to the asset as well. This was like being incurred as well. So this is the total cost incurred by William. And then later on 3rd of August 24, William is going to sell 2 hectares out of these 3 hectares. Though the purchase price of William's father is also given, but that is like not to be taken into account. Whenever something is being transferred as a result of someone's death as a part of their death estate computation, then it is always the market value at the date of death which shall be taken as the cost for the recipient. This may also be called as the probate value. Okay. So for William, the cost is of 28,600 as well as 500 pounds. So altogether, this is like going to be of 29,100 pounds, but this is like related to 3 hectares. And now what he is going to do, he is going to sell 2 hectares. So I'm going to apply part disposal formula, which includes market value of sold part as market value or the disposal value of the parts being sold as 92,000 pound divided over market value of sold part plus market value of unsold part. See, the market value of 1 hectare, which is like yet unsold, is of 38,000 pound. So it is to be multiplied with the cost, which is 29,100 pound, in order to see that how much of the cost is relevant to 2 hectares of land. And this is like going to be equal to 20,594 pounds. So 20594 is said to be the cost related to 2 hectares of land. So according to this, option C is correct. Then we have the third OT, which says that what is the amount of private residence relief available on the disposal of house by William? All right. I will be straight away taking you to the solution, but let me just show you the point where the relevant information is given. It says that William sold a house on 12th October 24, though he purchased a house on 12th October 2019. Throughout the period of ownership, William and his wife Jane occupied the house as their main residence, but 1/4 of the house was always used for business purposes. See, if any portion of the house has been used for business purposes, then it would not qualify for principal private residence relief. Rather, only the gain relevant to the private portion of the house shall be eligible to have an advantage of private residence relief. So, technically, first of all, we need to compute the gain as disposal value is of 840,000 pound and the cost is of 222,900. So by taking disposal proceeds first and then deducting the cost, the gain figure is of 617,100. And one quarter of the house was used for business purposes, so it will be chargeable, no relief is available. But 3 by 4th portion of the gain, as it is being occupied by the owners as their main residence, so this much gain is going to be waived off. This is going to be exempted under principal private residence relief. So 462,825 is said to be covered under principal private residence relief. So this much gain is not going to be taxed at all. Then we have fourth OT related to this OT case, which says that William's brother Luke has told William that it would have been better to have transferred 50% of the ownership of the house to Jane prior to its disposal. Which two of the following statements are correct? You have all the options in front of you. If William is like going to transfer 50% of the ownership of the house to his wife, that would mean that upon the disposal of the house, half of the gain will be chargeable upon William and half of the gain will be chargeable upon his wife, Jane. And they both will be able to use their annual exemption. Otherwise, if William had alone sold the house, then he could have had an annual exemption of 3,000 pound for once. But if he is like going to transfer 50% of the ownership of the house to Jane prior to like disposing it off to an unconnected person, then first of all, the transfer between them will take place at no gain, no loss basis. And then when they will be respectively disposing of their proportion, each of them, I mean, by William as well as Jane, they both will be having their portion of capital gains tax annual exempt amount of 3,000 pound. So if they would be having like 3,000 pound more, their chargeable gain will be reduced and their tax liability will be decreased. C, as according to the information given in the question, William is a high rate taxpayer, while Jane is a basic rate taxpayer. So if half of the gain is going to be chargeable upon Jane, then instead of paying taxes over the high rate, she will be paying taxes over the basic rate. And on the other hand, she will be able to utilize the basic rate, the capital gains tax annual exempt amount as well. But see, in this question, normally annual exempt amount could be available, but if you remember, then according to the information given in the question, Jane had already used her annual exempt amount. It is said in the question that Jane had already made a chargeable gain which has already consumed her annual exemption of 3,000 pounds. So this advantage is like no longer available, but at least she has some of the basic rate band available, which is like going to give an edge, an advantage of just charging a basic rate of taxes instead of charging higher amount of taxes. Okay, so see, if William retains the whole of the gain with himself, he'll be paying taxes over the high rate, which is of 24%, 24% being the high rate imposed as a result of disposal of residential property. Despite the fact one-fourth gain of the property will be chargeable, and that portion was being used for business purposes, but that wouldn't mean that that particular portion, one quarter of the gain would be considered as a non-residential one. The property is a residential one, though the use was not meant for private purposes. So the rates related to residential property are to be applied. But if William retains the whole gain with himself, he will be paying taxes at the rate of 24%. At least if 50% of the gain is going to be transferred to Jane, she will be accommodating some of the gain in the basic rate band, and thus she will be paying taxes at the rate of 18%, which is the basic rate, and thus avoiding the rate of 24%. So I just need to see that how much of the basic rate band is available to Jane, as the basic rate band has got a total value of 37,700, out of which Jane's taxable income is of 21,440. So I just need to see that how much of the basic rate band is still available. That is of 16,260. So 16,260 is the available figure of basic rate band which Jane has. And she will be like utilizing this band to compute CGT, where instead of paying taxes at the rate of 24%, she'll be paying taxes at the rate of 18% and thus saving taxes at the rate of 6%. So 16 to 60 into 6% would lead to a figure of £976 that is like going to be saved. She might have had another advantage. I mean, she could have reduced her taxes further as well if annual exemption was available, because on £3,000, as this is like going to completely reduce the amount of gain, she could be able to save taxes at the rate of 24% on £3,000. But this could only be done had she have still left with the annual exempt amount. But considering she had already used her annual exempt amount, which is why this advantage, this saving is no longer available. So how much of the tax could be saved in this regard? That is of £976. Now, taking you to the last OT related to this OT case, which says that what is the chargeable gain arising on the disposal of the warehouse by Luke in December 24, assuming all available reliefs are claimed. So let's quickly move to the point where this information is given. It says that Luke sold a factory for 230,574 and they have given you the gain figure of 31083. But then he has acquired another warehouse, so business asset is sold, and in shorter period of time they have acquired a new business asset, so rollover relief is available. And what do we need to consider over here? That what chargeable gain would arise on the disposal of the warehouse by Luke, especially with respect to the disposal that has happened in December 24. All right. See, first of all, back in October 2013, they have realized a gain of 31,083. Within few months, I mean, if the new business asset is going to be acquired within 3 years after the date of disposal of old asset, then rollover relief is available. And see, higher proceeds are, I mean, higher value has been reinvested as compared to the proceeds received. So when you are going to reinvest all or more, then whole of the gain will be rolled over. And how it is like going to be rolled over? The rolled over gain is going to get deducted against the cost of the new asset. So new warehouse, which was acquired in May 2014, had originally a cost of 231,211, but the whole gain previously generated upon the disposal of old warehouse will be rolled over, and this is going to get deducted against the cost of the new warehouse. And now the cost of new warehouse acquired in May 2014 will be 200,128. So it is like 200,128. This is like said to be the base cost of new warehouse, which was acquired in May 2014. But then later, recently in December 14, in the tax year 24-25, this warehouse is sold. Now, this is the disposal proceed and this is the cost. I just need to see what gain will be chargeable upon Luke, who is William's brother. And now, no rollover relief is available because as a result of disposal of this business asset in December, no new business asset is being acquired, neither within 1 year before the date of disposal nor within 3 years after the date of disposal. I mean, no such information is given. So, no further rollover relief shall apply. Let me just take you to the standard solution. As now, this new warehouse is being sold in December for a proceeds of 270,213 and the base cost is 200,128. This would result into a chargeable gain of 700,085. This is like said to be the chargeable gain on which Luke will be held liable to pay off the taxes. So this 70,085 pounds is the answer. Is this thing clear? So the answer is 70085. Now, students, we are still having one OT case, but as the time is up, I'll be sharing the files with you people. You may have a look at what the third question was and what were their OTs and the relevant solution. But whatever you have learned in today's session, let me know it first that whether you had been able to understand any of the concept related to taxation. I mean, had you been able to gain any knowledge in this session? All right. Okay. So, if there is like still any issue that you have faced as far as this session is concerned, or anything in general related to taxation, you may please let me know by dropping your concern in the dialog box, and afterwards I'll wind up the session. All right, since there is no question, so I'm going to wind up this session. I just hope that the session had been fruitful for you people. All the documents that I have used in this 2 days session will be shared with you all, along with the pocket notes and the relevant important documents, which will help you for your exam preparation. The time has come to wind it up. Thank you so much for being a part of this session once again. Goodbye.